September 24th, September 26th, Wednesday 2018. Let's recap where we took off from last week and earlier this week. So I'm getting a number of calls asking me what system I use. It's not so cut and dry. First of all, there's different systems for different market conditions. You have to have a system for trading or you're lost. You have to have a set of rules. You have to have buy stops, profit objectives, stop losses. That's true. But there's rules for different conditions. For example, if the S&P is above the above the daily averages and it's in an uptrend and it's up big, there's going to be different buy rules than if the S&P is down 25 to 30%. If it's down 25 to 30%, you may be more lenient in where you buy because it's down a lot and you don't want to miss a potential big move because the risk reward adjusts. If it's down 30, 40%, the potential reward is much greater than the risk. So you have to have different rules for different market conditions. And the only way you could learn those market conditions is by sitting on a desk and going through it for a few years. Any guru or supposed guru who tells you differently market conditions is wrong. The only way you... Another question that people ask me are the trading times. What do you use? See different people out there using 5 minute, 15 minute, 60 minute, trying to day trade basically with small, short-term technical trading patterns. I could tell you big funds don't trade that way, and big funds are the ones that make the money. And we try to follow what the big funds are doing. I know it makes for interesting commentary because there's more to talk about when you look at a 5 minute chart, 10 minute chart, 15 minute chart, 60 minute chart. You could look at all these retracement levels. You could look at so many things. But the fact is that's too short term for technical trading. It's good if you're trading in the pit where things are changing moment to moment, but you don't get as reliable a signal when you were looking at something like a 3 minute chart, a 5 minute chart, 10 minute chart, 15 minute chart, 60 minute chart. Lastly, before I start with the analysis, retracement levels. Not a big fan of them. There's so many of them. There's the 38.2, there's the 50, 61.8 or whatever, 78.6, 1.25. I only use retracement levels where everything else lines up with other things, because let's say you lose at the 38, you lose at the 50, you lose at the 61, you're finally right at the 78, but you've lost 3 times. You know, big deal, something's retraced 38%. It's not such a reliable signal, and it's definitely not reliable on you know, when I first got into this business, I would subscribe to every service. They would talk about retracement levels on the 5 minute chart, the 10 minute chart, the 16 minute chart. I don't know what to say about that except it's nonsense, to put it bluntly. I don't want to mislead you. It's better to have less analysis and be correct in the analysis than over-analysis and give, you know, trading is like life. There are only so many opportunities. In life, there's not an opportunity every day. It's like trading. There's only so many opportunities that you have. Now, you got to be there when the opportunity is there, but Jesse Liverpool said most of his money was made by waiting. Trading is made by waiting. You got to be like a cheetah, waiting, 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 and then strike. But don't overtrade. You'll just lose your money and your mind. So I look at daily, weekly, and monthly charts. Okay, so let's start with, in those charts, I also look at the daily averages, the weekly averages, and pivot points. So daily, weekly, monthly charts, daily averages, weekly averages, and pivot points is what I look at. Now, the only way you could really understand what I'm looking about is spending the time. It's not going to happen in a day. It's not going to happen in a month. It's not going to happen in 3 months. It's probably going to happen within a year. But you got to put in the time. It takes 8 years to become a doctor, 5 years to become a lawyer. Trading is harder because of the emotions, the discipline, chasing trades, chasing missed trades, losing trades, and trying to catch those trades you've lost. So You got to be very careful. It's your money at hand here. Okay, enough of that. Enough talk for now. Let's get back. Let's get into the analysis. We always start with the S&P. Let me bring up an S&P chart. I'll bring up a daily. Here's the daily S&P. Down here is the stochastics. Above this line, above 80 is overbought. Below 20 is oversold. And here are the moving averages. There's always, I use 4 moving averages, the 50, the 100, the 150, the 200. Just remember, if you want to remember too, remember the 50 is red and the 200 is black. The 50 is red, the 200 black. So the 50 moving average is 28.66, where my cursor is. Sorry about the interruption, gang. Technical difficulties. Got stuff reinstalled on a new computer today. So bear with me for about 2 minutes in the beginning. Okay, let's look again. We always start with the S&P. So where are we at now? We're at 2934 here. You can see things are way up. So we're not buying. One of the rules we have is we don't buy above moving averages. This is the 50, the red one's the 50, the black one's the 200. Now there are some exceptions, and one of the exceptions is on a big down day. We'll buy in certain scenarios. So when those days occur, I'll be there with you to discuss. But obviously it's not a big down day today. So we are not buying on the S&P on a daily chart. Bear with me as it's good for you guys to learn here. I'm going to install a relative strength index, stochastic. Put these numbers down. These are overbought, oversold levels. Okay, so that's our S&P. You can see on a stochastic level, we're not oversold, obviously. We're obviously more towards the overbought level. Remember, we don't like, as I talked about last week, buying above 50 on the RSI. And the RSI here, 65.30. So S&P looks great. It took out this pivot high over here, but it's still way up. Got to have it pull back. We're looking for a big down day, and we're going to try to buy in the afternoon, or at least it's got to come into here. If we look at a weekly chart of the S&P, you can see how up it is, and you can see it's above the 50 on the stochastic level. So monthly chart, it's obviously all overbought. Boom. Amazing, eh? From these 2009 lows, it hasn't even broken a trend line. If you want to draw this, hasn't broken. Looks great, but we gotta have it pull back. Okay, so the S&Ps, let's go back to our daily chart. 29.35 looks great, but we ain't buying it. Risk to reward's too high. I mean, look, if you would have bought up here, you would have gone through a lot of pain. 27.91. In some cases, you go through like 150 points of pain. You buy here somewhere, drops here. You buy here, drops here. You buy here, drops here. So we got to have it pull back. So nothing to do there now. Okay, let's look at the Dow. And you get 26,595. It's the same thing as the S&P, basically.
Interesting thing about the Dow is it's below this pivot point over here, which is not a great sign, this high in January 2018. The high there is 26,000 something. Let's take a look. 26,616. And we're at 26,592. It's below that pivot high. If we take a look at the S&P, you can see it's above. So it's a little bit of a divergence there. The Dow's not following as strongly. Okay, let's take a look at bonds. We talked about this last week. I don't think things are changing. It's in a downtrend. We don't like the short-term moving averages are below the long-term moving averages. The 50 is below the 200.